Hello, champions. In your entire CA Inter DT syllabus, you have the life insurance concept in totally 5 places. Okay. Out of these 5 places, in some places we talk about premium, in some places we talk about maturity proceeds, and this is where a silly mistake happens in the examination because our brain is so trained that as soon as we see this word life insurance, we immediately think about ATC, nothing else comes to our mind. But however, there are 5 different concepts involved. ATC is only one out of these 5 concepts. So come on everybody, let's ensure that we don't make a mistake on this if this comes in our examination. Okay, my very first point is from the salaries head point of view. So in case a life insurance premium of the employer is paying, in simple words, employee's life insurance policy, guys, his premium employer is paying, it's clearly a benefit which the employee has enjoyed. It will become a taxable perquisite for the employee. See, if the employer is paying any other premium for the employee, like if the employer is paying health insurance premium for the employee, or if the employer is paying personal accident insurance policy premium for the employee, all that is exempt perquisite, right? But life insurance premium paid by employer for the employee will be a taxable perquisite for the employee, and for the employer it's an expense, right? He's making the payment, it's an expense for him. So for him it will become a business expense which you will allow under the PGBP head for the employer. Okay, first adjustment simple, life insurance premium for the employee paid by the employer. What will you do? For the employee it will become a taxable perquisite, for the employer it will be an allowable business expense. Alright, now comes our second adjustment. Now this is the adjustment which you know very nicely. Section ATC, life insurance premium. So here what happens is assessee is making the payment, guys. Assessee is making the payment of what? Life insurance premium. The life insurance policy is in whose name? Self, spouse or children. Assessee can be resident or non-resident, doesn't matter. The life insurance policy can be an Indian policy or a foreign policy, doesn't matter. What is the situation over here? Assessee is making payment of premium on a life insurance policy. The policy is in whose name? Self, spouse or children. Children can be dependent, independent, major, minor, own children, adopted children, stepchildren, doesn't matter. All kind of children included over here. No limit on the number of children also over here. Okay, now this premium which the assessee has paid, this premium will be allowed under section ATC. But there is a maximum limit. For premium, there's a maximum limit. How much premium can be allowed under section ATC? That will depend upon the date of policy. If the policy was taken before 1st April 2012, then maximum 20% of sum assured will be allowed. If the policy was taken on or after 1st April 2012, then maximum 10% of sum assured will be allowed. If the policy was taken on or after 1st April 2013, but the person in whose name the policy is taken, that person happens to be either disabled under section 80U or is suffering from a disease under section 80DDB. So in such case, the maximum premium will be 15% of sum assured. Understanding? So whatever premium assessee is paying, that premium I will allow under ATC, but subject to a maximum limit. The maximum limit will depend upon the date of the policy. So the maximum limit can either be 20% of sum assured or 10% of sum assured or 15% of sum assured. Okay. Now this 15% point, be careful. Am I saying assessee should be disabled? Am I saying assessee should be suffering from a disease? No. I'm saying that the insured, the person in whose name the life insurance policy is taken, that person has to be disabled or that person has to be suffering from a disease. Only then this 15% limit will apply. Understanding? Let's say assessee is taking a life insurance policy in the name of his spouse and the spouse is disabled. Then in that case, for that policy, the maximum limit will be 15% of sum assured. Okay, let's take an example now. Let's say the assessee is a non-resident. The assessee is an individual. Assessee has taken a life insurance policy. The policy is in the name of his spouse. And who is paying the premium? This non-resident individual. He is the one who is making the payment of premium. He has paid premium of 1,80,000. Alright, and the policy was taken on the 1st of April 2016, and the spouse happens to be disabled, let us say, and also let us say that the sum assured for this policy was 20 lakh rupees. Okay, so this is the facts which I have given to you in this question. Now tell me, maximum how much premium will be allowed? The maximum premium will depend upon the date of the policy, guys. See here, the policy is taken on the life of a person who is disabled. Self, spouse or children. Policy can be taken in the name of self, spouse or children. Policy is taken in the name of spouse, but the spouse is disabled. So therefore, the third bucket will apply. Policy is taken on or after 1st April 2013. So the maximum limit will be 15% of sum assured. So 20 lakh into 15%, that is 3 lakhs. This will be your limit. How much premium are we paying? 1 lakh 80 only. It is within the limit. So therefore 1 lakh 80,000 will be fully allowed under section 80C. But then after this, you should not forget to apply section 80CCE limit. What does 80CCE say? 80CCE says 80C plus 80CCC plus 80CCD subsection 1 put together should not exceed 1,50,000, guys. In our example, our ATC is 1,80,000. We don't have any 80CCC. We don't have any 80CCD subsection 1. So the total is 1,80,000, which you will restrict to 1,50,000. So finally, under 80CCE, I will get 1,50,000 deduction under chapter 6A. Understanding. So there are how many limits now? There are 2 limits. So first you will apply the limit for the premium alone, which will depend upon the date of policy. On the basis of 20%, 10%, 15%, you will arrive at the maximum premium which is allowed under ATC. But after you do this limit, don't forget ATCCE, because the whole of ATC, whole of ATCCC and ATCCD subsection 1 will then go to ATCCE, which says total put together it should not exceed 1,50,000. Understood, everybody? So this was your second adjustment. The first adjustment was life insurance premium for the employee paid by the employer. For the employee, it's a taxable perquisite. For the employer, it's an allowable business expense. Then our second discussion was about life insurance premium paid by the assessee for himself, his spouse, or his children. The premium will be allowed under ATC, but maximum how much premium will be allowed, it will depend upon the date of policy. It can be 20%, 10% or 15%. Then once we apply this limit, we should also remember to apply the ATCCE limit of 1,50,000. Okay. Now listen to the third point, the most important point, the start discussion of this session, guys. Life insurance maturity proceeds, which is generally exempt under section 1010D, but there are 4 cases where it is taxable also. First of all, understand what the whole transaction is. See, in life insurance premium, we are having an expense, we are making a payment, okay, but in life insurance maturity proceeds, we are getting an income, there's an inflow. The life insurance company is giving maturity proceeds to the assessee. So for the assessee, there is an inflow, there's an income. Now this income will either be exempt or this income will be taxable. It actually depends upon 6 situations. I'll discuss the 6 situations with you one by one. So what is the situation over here? What's the main situation? Assessee has received maturity proceeds from the life insurance company. These maturity proceeds are an income for the assessee. Either the maturity proceeds will be exempt or they will be taxable. It depends upon 6 situations. We will divide the 6 situations into 2 buckets, guys. 4 situations, we learn them separately, and then we will see 2 situations separately. Okay, let us talk about the 4 situations first. These are the easier ones, the shortcut ones. One line adjustment only, very simple. See the first point over here. If the maturity proceeds are relating to term life insurance policy, they will always be exempt. You don't even have to check anything else. It will always be exempt. Then second point, if the maturity proceeds are received upon the death of the insured, even over here, the proceeds will always be exempt. And when I say exempt, they will be exempt under section 10D. Okay. Then if the maturity proceeds are relating to key man insurance policy, here the proceeds will always be taxable, guys. Either it will be taxable under the IFOS head or it will be taxable under the PGBP head, but it will always be taxable. Okay. Be careful. Even if the proceeds are received upon death, doesn't matter. If it is a key man insurance policy, it will always be taxable. Alright. Then we have a policy in section 80DD also. Even the maturity proceeds of the 80DD policy, even that will always be taxable under the IFOS head. I'll give you a quick reminder of this 80DD policy. Okay. 80DD, guys, you have this section in your chapter 6A. So there's an assessee. This assessee is having a dependent relative who is disabled. Assessee has a DRD. Assessee himself is not disabled over here. Assessee has a relative who is dependent on the assessee and he is disabled. So assessee has taken a policy for the maintenance of this dependent relative who is disabled after his death. So basically assessee's point of view is that while I am alive, I am taking care of this DRD, but what after my death? So assessee is taking a policy for the maintenance of this person after his death. Okay. Now, but however, sometimes what happens is this dependent relative who is disabled, he may predecease the assessee. Predecease the assessee means he may die during the assessee's lifetime itself, he may die. In that case, whatever money got accumulated in this policy will get returned to the assessee. So assessee will be receiving money from the life insurance company, guys. Assessee will be receiving maturity proceeds. There's an inflow for the assessee. So this inflow is what we're talking about. This inflow will always be taxable for the assessee under the IFOS head. Understanding? So in case the assessee is receiving maturity proceeds from LIC, you will always follow the sequence, whether MCQ question, whether descriptive question, I don't care. You will always follow the sequence, no jumping over here. Getting my point? So what is the sequence? You will first of all check, is it term life insurance policy? If yes, fully exempt. If the money is received upon death, fully exempt. If the money is received from a key man insurance policy, fully taxable. ATDD policy also fully taxable. But however, let us say it is not coming under any of these four situations. Then only you will come to these two situations. Okay, now come on, let's try to understand what these two situations are. So by the way, when will you apply these two situations? You will apply these two situations only if these four situations are not applicable. So none of these four situations are applicable, which means the policy is not a term life insurance policy, money is not received upon death, it is not a key man insurance policy, it is not an ATDD policy, it is none of these four situations. And the second condition is that the premium happens to be more than the limit. What is the limit, guys? Just now we learned that the limit depends upon the date of the policy. So the premium happens to be more than 20%, 10%, 15% as the case may be. So if this happens, then whatever maturity proceeds you have received, those maturity proceeds will be taxable. Alright, taxable under IFOS. Alright, this is the first situation. So in the two situations, the first situation is where none of the four situations is applicable and the premium happens to be more than the limit, then the maturity proceeds will be taxable. Then comes the second point. Again, same thing, guys. The four situations, none of the four situations are applicable over here. It is not a term life insurance policy, money is not received upon death, it is not key man insurance policy, it is also not ATDD policy, none of these four situations, okay. But the premium happens to be within the limit, guys, because if the premium was more than the limit, it will get covered here itself. But premium is within the limit, it is within 10%, it is within 15%, it is within 20% as the case may be. Then third point is that the date of policy happens to be on or after 1st April 2023, and the last point is that the aggregate premium of these policies, the aggregate premium per annum for these policies happens to be more than 5 lakh rupees. If all these conditions are fulfilled, then the maturity proceeds from this policy will also be taxable. Okay, getting it? So totally, in how many situations will the policy in how many situations will the proceeds be taxable? The proceeds will be taxable in 4 situations, guys. If it is KMIP, the proceeds will be taxable. If it is ATDD policy, also the proceeds will be taxable. If it is none of these 4 situations but the premium is more than the limit, here also it will be taxable. If it is none of these 4 situations, premium is also within the limit but the policy is taken on or after 1st April 23 and the aggregate premium is more than 5 lakhs, here also it will be taxable. Getting it, guys? So simple, very easy. There are 4 situations where these proceeds are going to be taxable. Apart from these 4 situations, if it is any other case, it will be exempt. See, in case it happens in the examination, okay, that none of these situations are applicable, it will be exempt. If they just say maturity proceeds of life insurance policy, exempt. Understanding? If none of these situations apply, straight away exempt. Default answer will be exempt. Only in these 4 cases, only it will be taxable. Okay, now see, for some of you, this might have felt like a different concept. Some of you might have felt that, ma'am, this is so weird. First time I'm learning this. Some of you might be feeling like that. Please know that this concept has not been tested much till now, but it is a part of your syllabus. And even in the May 2024 RTP, they did test this part. Even in the September 2025 RTP, your RTP also, they have tested this part. So I don't think it is right for us to ignore this concept anymore. And that is why I have discussed it with you over here. Trust me, you just got to apply these 6 situations and give your answer. Okay, everybody. So my first concept, life insurance premium paid by employer, taxable perquisite for the employee. Then my second concept was life insurance premium paid by assessee. It is allowed under section 80C, subject to a limit. The limit will depend upon the date of the policy. And then don't forget to apply 80CCE 1,50,000 limit also. Then came our third discussion, the big discussion where we spoke everything about the maturity proceeds relating to life insurance policy. It's an income for the assessee. Either it will be exempt or it will be taxable. In only these 4 cases, only it will be taxable. All other cases, it will be exempt. Now come on, everybody. Just 2 more final points. Just 5 minutes we will get done. My next point is with respect to TDS. Life insurance maturity proceeds does come under TDS also, under 194DA. Very easy section, guys. After we have learned these maturity proceeds, this 194DA will become very easy for us. 194DA will apply only if two checkpoints are fulfilled. Checkpoint number 1, the policy has to be a taxable policy. What do you mean by taxable policy? You know very well, only these 4 situations are taxable policy. So condition number 1, checkpoint number 1, the policy has to be a taxable policy, and checkpoint number 2, the maturity proceeds have to be at least 1 lakh. Guys, it's an abnormal limit. I am not saying more than 1 lakh. It should be at least 1 lakh. Only if both these checkpoints are fulfilled, only then you will enter into the section. Once you enter into the section, TDS will apply either at the rate of 5% or at the rate of 2%. Earlier it was 5%, but with effect from 1st October 2024, the TDS rate is 2%. Okay, but this TDS rate will be applied on what? On the net amount, not on the maturity proceeds, guys, on the net amount. Net amount means maturity proceeds minus aggregate premium paid. See, be careful, it is minus aggregate premium, not annual premium. Like for example, let's say the policy was existing for 5 years. So in these 5 years put together, total how much premium I paid, that aggregate premium is what you will subtract over here. Understanding, everybody? So under 194DA, we're talking about TDS on life insurance maturity proceeds, but this section will apply. You can enter into this section only if 2 checkpoints you fulfill. Checkpoint number 1, it should be a taxable policy, which means it should be 1 out of those 4 policies, and checkpoint number 2 is that the maturity proceeds have to be at least 1 lakh. Okay, only if both these conditions are fulfilled, welcome to 194DA. Once you enter into 194DA, TDS rate is generally 5%, but with effect from 1st October 24, the TDS rate is 2%. And mind you, here TDS will be deducted at the time of payment, not payment or credit, whichever is earlier, at the time of payment. Okay. And lastly, this TDS will be calculated as a percentage of what? As a percentage of net amount, that is the maturity proceeds which we are receiving, this minus aggregate premium paid all these years. On that net amount, we will calculate TDS. I'll tell you one small silly mistake that is possible over here. This net amount, do you care about whether this net amount is more than 1 lakh or less than 1 lakh? Will you care about that? No. What has to be at least 1 lakh? The maturity proceeds have to be at least 1 lakh. The net amount, whether it is more than or less than 1 lakh, doesn't matter, guys. Whatever is the net amount, that into the rate will be your TDS. Understanding? Yes, but don't forget, don't straight away do the calculation. First, you have to pass the checkpoint, only then you will come to the computation. Okay, and then coming to one last point relating to life insurance. In case you're making payment of life insurance premium more than 50,000 rupees, doesn't matter what is the mode of payment, the mode of payment is irrelevant. If you are paying life insurance premium more than 50,000 rupees, then it is mandatory you have to quote your PAN, returns of income chapter, guys. I already spoke to you about this in return of income also. Just putting it here as well, because we are trying to create one file with all the concepts relating to life insurance premium in our examination. Alright, that is it, guys. 5 concepts, nothing else in your syllabus with respect to life insurance premium. So the biggest learning that you have through this entire discussion is that as soon as I see life insurance, ATC is not the only thing that should come to my mind. 5 adjustments are possible. I'll pause once, I'll think once, I'll assess once that which of these 5 concepts will apply, and accordingly I will give my answer. Alright, everybody. Yes, so with this I'll close. I'm sure you've understood everything else, but you should tell me in the comment section whether you've understood this third point. Especially, guys, I'm really particular about this. If these 4 situations exist, then it will be taxable. In all other cases, it will be exempt. Alright, guys. Yes, you'll handle it. You better be able to handle it. Thank you, guys. Bye-bye.